Good afternoon. I'm Arlan Suderman, Chief Commodities Economist with INTL FC Stone, and it's great to be back with you this month for the February crop report. Not typically known as being an earth-shattering report as far as the information in it, but more significant certainly than what we were a decade ago as South American production takes on increasing importance. So from that standpoint, this is equivalent of, say, maybe an August crop report. As far as implications on the markets, when we look at the size of the crops in South America, that certainly does have implications for U.S. exports, especially for corn and for soybeans. I guess I better put the disclaimer up there to make sure that we have it up there and give you all a chance to take a look at it, and then we'll move forward and talk about the context of this report. As always, I start with the fact that price is still a function of supply and demand, but it's modified by the flow of money. And that is certainly a much bigger impact today than what it was 5 or 10 years ago, is the amount of money that's available to these markets and the influences from day to day. We can certainly show the evidence that the amount of money flow and the direction of the money flow does have an impact on price movement, both in the short term and in the long term. And so it behooves us to have an understanding of the context of that money flow before we get into the actual supply and demand fundamentals that's discussed in today's USDA crop report. So first of all, I want to take a look at this weekly dollar chart. This goes all the way back to the fourth quarter of 2009. And here again, you see the rally in the dollar. And back in 2014, as we were looking at no longer expanding the quantitative easing program or stimulus program that the Fed had in place, not doing any tightening yet, and then we chopped sideways for a period of time from the first of 2015 for about the next year and a half or a little bit more on the debate, when would the Fed actually start tightening? When would it start raising interest rates? And when would it actually start withdrawing some of the stimulus in the system, which right now totals about $4.5 trillion in assets. And then over the latter part of the summer, the dollar started rallying higher again and accelerated this fall around the election on expectations that a Trump administration that was successful, if so, in tax and regulatory reform could stimulate the economy from a fiscal standpoint, and that the Fed might have to speed up its monetary tightening policy, so the dollar rallied. But as we got into that January time period, that's when we saw the dollar pull back on fears that the Trump administration might create trade wars and other problems that might derail its efforts to try to get tax and regulatory reform. We've seen a little bit more strength here over the last week as the Trump administration has been able to channel the headlines a little bit better, even with all the court rulings on trade restrictions, with all the meetings of business and corporate executives at the White House. And even today specifically, we saw the stock market hit new record highs for the major indices after President Trump made a comment to reporters that they can expect some very good news in the way of details of the tax reform package within the next 2 to 3 weeks. And Wall Street certainly reacted to that well with stocks, but also with the dollar rallying. The dollar also facing some upward pressure as the euro comes under pressure once again. Look for Greece to come back into the headlines again as it's still in trouble, and I've been warning that that'll be an issue once again. Of course, we have a number of other things. And we saw the lower house of parliament give a sounding, strong, approval of the bill to allow Theresa May, the Prime Minister of Great Britain, to file the Article 50 papers for separation. None of that is good for the euro, and that pushes the dollar up. Nonetheless, so a strengthening dollar tends to be negative for the commodities. The other side of that, if the dollar is strengthening, what's happened to the other currencies that we compete with? And here's a list of currencies looking back at the last 2 years of how they have traded relative to the dollar. Virtually all of them, and these currencies are countries we either compete with in the global market or who buy from us in the global market. and they're all losing value, and that's negative for the commodities, makes it difficult for us to compete. In this graph, we should look at corn prices, the dark lines in Chicago Board of Trade prices, and the lighter blue lines here on the left would be the price in Brazilian reais, and on the right, Argentine pesos. And while we've been dealing with prices near multi-year lows, Brazil's prices are much better with the weak currency. Now, the currency really does come into play in affecting the farmer selling as well as planting decisions. They've been rapidly expanding corn production in Brazil, partially due to the weaker currency. And you look at corn prices. We're still talking corn prices in Argentina. They're dealing with multi-year high prices or close to it, encouraging expansion of corn there as well. Here's the same charts on soybeans. Here again, look at soybeans in Argentine pesos. Multi-year high prices are close to it, and even better prices in the way of in Brazil as well, more profitable. So while we're trying to eke out a return to variable costs here in the United States, it's a little better picture, considerably better picture in parts of South America. This graphic you've seen before, but I just want to remind us again, we saw the rapid expansion in the commodity boom in the 70s and land devoted to crops, the major crops. And most of that growth took place in the United States, Canada, and European Union. And then we went for quite a period of time where prices kind of stagnated. Occasionally we'd have a rally, not too much growth, ahead of the commodity boom in the early 2000s. And once again, land expanded. This time around, the expansion, about half of it was in South America, and the other half was evenly split pretty much between Africa and the former Soviet Union, throw in a little bit of CRP ground here in the United States. So in times of surplus, which we've certainly had here in the United States, the job of the market is to drive prices lower to stop this expansion. But overseas, where their currencies are much weaker than the dollar, it's still encouraging expansion, and that's a problem for the U.S. markets. As we look at the CRB Index here, this tends to go opposite of the dollar. There's a strong indirect correlation between the dollar and the CRB Index. There's a number of different commodity indices out there. Some of them are equally weighted between anywhere from 17 to 25 different commodities. This particular one tends to be more heavily weighted to the energy sector. You can see that we went through a period of rapid growth last year, and then we kind of stagnated sideways, and then late last year we went up another notch, largely led by crude oil, as OPEC talked about, and then is actually able to achieve an agreement to reduce production. But again, prices are stagnating. If we look at West Texas Intermediate crude oil lead contract, really kind of stuck between $51 and $54 right now in that sideways trading range. Not a lot of risk premium in that market for tensions in the Middle East, which has certainly been rising in recent days between Iran and the United States. So that's something to watch. At the same time, the market also focusing on the big increase in shale oil production we're seeing as a result of this price increase. As we look at the CRB Index, which is in this orange line once again, which I showed you a chart earlier, this shows it on the orange line. The shaded area behind that orange line is net fund ownership of corn, soybeans, Chicago wheat, Kansas City wheat combined. And you can see the correlation of 0.73 up here in the upper right-hand corner, showing a pretty strong correlation between corn, soybeans, and wheat. So when the funds are buying the CRB Index or many of the other major commodity indices, they're in essence buying contracts of corn, soybeans, and wheat and help prop up prices. Of course, the opposite is true as well. So the bottom line is, when the dollar is rallying, the funds tend to sell the commodity indices and sell corn, soybeans, and wheat. And when the dollar is weaker, they tend to buy the major commodity indices and tend to buy corn, soybeans, and wheat, seeing it as more competitive on the global market. As we look at today's USDA numbers, particularly the key numbers we'll look at, really South America is what we focus on this time of year. And the only real change in today's report would be that Argentine soybean production estimate of 55.5 million metric tons, down 1.5 million metric tons from the previous month, but not down as much as what the trade expected. The trade was looking for another million metric tons below that at 54.5 million metric tons. So not as big a reduction in Argentina as expected. They did leave Brazil at 104, and the latest data would suggest that maybe that will move higher in the month of March. So what's the excuse me, I should point out that Argentina and Brazil corn stayed the same. Note that our team in Brazil has the corn crop at 91.5 million metric tons. Excuse me, if we get that, we're going to have trouble finishing the year with good exports here in the United States, and that'll certainly have an impact on the 2017-18 marketing year corn exports as well. On the other hand, if we repeat last year's weather problems, we'll see those exports rise. Ending stocks, USDA coming in on wheat at 1.139 billion bushels, largely because it increased exports 50 million. 25 million for hard red winter wheat, I believe it's 15 million for hard red spring, and about 10 million off the white wheat with stronger exports. Exports have been good for the quality wheat. We've been competitive because of the low cash prices. We expected this boost in exports, just didn't expect it all in the month of February. So USDA certainly given us a gift there. Notice how close it comes to our estimate. Obviously, our estimate for corn is much higher, and that largely goes back to this corn production estimate for Brazil, 91.5 million metric tons. If, in fact, Brazil produces a corn crop of that size, we're going to have trouble hitting USDA's target. I would also argue USDA's feed usage target is still a little bit on the high side as well. On soybeans, expecting USDA to eventually raise its export target, but still they're staying in there, 420 million bushels. We'll show you a graphic a little bit later showing USDA's track record on that account. Winter wheat stocks remain massive. We break it down by class here. Soft red winter wheat certainly has the largest supplies as a percent of annual usage or in terms of days of supply. Really looking at nearly an 8-month supply right now. Hard red winter wheat had been up in that territory. Now suddenly hard red winter wheat is down closer to a 7-month supply. So they're getting a little bit better. Still bearish by all means, but not quite as bearish as what it was a couple of months back. Hard red spring is where the real demand has been. Now, demand for hard red winter has been good as well, but the supply was just so big. Hard red spring, though, you certainly see why there's a premium in that market because of the demand drawing down stocks. Corn stocks in absolute terms, basically at a 29-year high, crept down a little bit today on the stronger ethanol demand usage. Also in the grain sorghum, we saw USDA cut exports by 25 million, but to shift that over to feed usage, so ending stocks remaining the same. When we look at global corn stocks, we see that nearly half of those surplus supplies are in China, a little better than a quarter of the stocks are in the United States. So between China and the United States, that's 3/4 of the world's corn. So what about the other 25%? Well, we take a look at this chart. We see here, first of all, in this chart going back 20 years, that global stocks are down to about a 78-day supply when everybody is included. If we take out China and the United States, that drops down to about a 42-day supply. Now, this report lowered the total stocks number, but left the number that excludes U.S. and China pretty similar condition there. We did see USDA bump Chinese corn demand by about 4 million metric tons, providing some encouragement of long-term demand, but their near-term supplies remain big. Here again is a graph showing the parabolic growth in Chinese soybean demand and the imports that tend to follow it. USDA tends to underestimate that demand. You see the gap here at the chart relative to that trend line. And then by the end of the year, they tend to close that gap as they recognize the demand is certainly there. So let's take a look at that. First of all, we look at soybean exports, where the final exports come in for soybeans relative to USDA's February estimate, almost said January, to the February estimate. And you can see, for example, that last year, exports ended up 250 million bushels larger than what USDA estimated in the February crop report. That had a huge impact on lowering ending stocks by the end of the year. And the trade is assuming that that's going to happen once again. Will it happen? That's yet to be seen, and largely dependent on what kind of crops we grow in South America, how much export business will go that way, and then will it come back by the end of the year because demand simply absorbs it all as it did last year. Now, when we look at the impact that has on final ending stocks, you can see that USDA is very good at one thing. They're very good at overestimating soybean ending stocks in the February crop report. Excuse me, I'm trying to hold on my voice here. Excuse me. But particularly in the last couple of years, USDA's overestimation of final ending stocks has been very significant, and the trade is assuming that that's going to happen again this year. Whether it does is largely going to hang once again on the final size of the South American crop. So then that brings us back to overall the growing season. We should say that the weather, I don't have a graphic here. The weather in Brazil is expected to continue to be generally favorable, with some rains continuing to create some soybean harvest problems and safrinha corn planting problems in the northern belt of Brazil. But yet our people down there say that they're still getting the crop in. Soybean harvest, while slower than expected, is still at a record pace. Safrinha corn planting is slower than expected, but still ties 2010 for a record pace. So the weather is generally supported, getting enough rain that they're able to get a good start to the safrinha corn crop, but the rain has enough breaks in it that they're able to harvest the soybeans and turn around and plant corn. Excuse me, so pretty good growing season overall. Now as we look at the spring here, one thing that really stands out is that cold push of air down through the northern plains and much of the Midwest in March. Retreats a little bit in April, but the northwestern Midwest is still pretty cool, and even that coolness lingers on into May. Notice the wetness in that area as well, particularly for April, May, that northwestern Midwest. Much of this is due to the heavy snowpack that we see in the northern plains. That's going to slow the warming of the area. It's going to facilitate precipitation and perhaps some flooding. So let's look ahead now to the summer. That was for the spring. Could be some planting issues in the northwestern Midwest. That would tend to favor more of a shift from corn to soybeans. Now, what about the summer weather patterns? Well, this is more of an art than a science at this point. But what Commodity Weather Group did is went back and looked at years, found other analog years that we were going from basically a weak, a neutral to weak La Nina to a neutral to weak El Nino, which is what the forecast models are largely calling for. And I'll have a look at those models here in a little bit. And if you put those in analog years into one composite forecast, it tends to come up with this forecast, which is cool, as illustrated on the right for June, July, August period. And normal to above normal precipitation is shown in the map on the left. Now, not all years are created alike. So when you take a look at other factors, when you're dealing with a neutral to weak, be it La Nina or El Nino, then that allows other factors to be strong influences. The number one influencer we look at is sea surface temperatures off the Baja of California. They are currently warm, and if they stay warm, in those years that stay warm, that tends to support that cool, mild, wet type of forecast for the Midwest. Now, if you put those composite years when we had that warm waters off the Baja of California into a composite forecast, well, we see temperatures tend to be below normal for the summer, as shown in the graphic on the right. Precipitation tends to be above normal as well, but you'll notice that 1993 is one of those years, and that heavily biased that chart to the wet side when I made it. Another factor to watch is that cool pool of water off the Gulf of Alaska, shown in the upper right-hand graphic there. If we look at the analog years, this is a fairly common trait to have that cool pool there. Now, the forecast models are calling for it to moderate here in the months ahead, and generally that's expected, and based on the ENSO cycle we are in. If it does, that here again supports that cooler, more favorable growing season for the Midwest. If it does not cool, if it remains warm, then that tends to produce, as we see illustrated on the bottom graphics, a hot and dry forecast. Excuse me. So there are a lot of uncertainties yet for the Midwest summer forecast going forward. How will this pattern play out, and what kind of safrinha corn crop and Argentine bean crop will we have underlying this unknown for the summer season? Here's USDA's forecast for normal to above normal precipitation for the Midwest this summer, and normal to below normal temperatures for the Midwest. Now, they took those analog years once again and broke them down kind of into subsets, and they found that basically you look at the 27% chance of hot and dry and a 39% chance of cool and dry. So you add that together, and that's basically a 66% or 2 in 3 chance of dry weather this summer. Excuse me, but when you look at the precipitation side, a 3% chance of hot and wet, 31% chance of cool and wet. So you break it down, you have a 66% chance of something warmer than normal, and you have, what is that, about 60% chance of something cooler and wetter than expected. So overall, it looks like a summer to really keep track of things. And take note here, all of them still tend to have above trend yields, except for this hot and dry scenario. And in fact, the European model that just came out yesterday, it's one of 20-some models, but the European model calling for a more rapid and stronger transition to El Nino. And if that happens, that tends to be pretty good for much of the Midwest, but tends to be hot and dry for the northwestern Midwest. So that may be an area that we have to watch for potential weather problems down the road. Okay, the moment you've been waiting for. Looking at where do we go from here? What about the crops? I've given you the stocks. I've given you the weather outlook going forward. So let's take a look at the numbers. Focus on the bar on the left. Now, if you assume, and pay attention to these numbers at the bottom because they provide the parameters for my analysis, based on a client survey we did in December, based on other research we've done, we're right now at 89.5 million acres of corn. That would be down 4.5 million from 2016. If you plug in then a 170 bushel trend yield, which is a little bit less than what USDA will be at, that would give us ending stocks just below 2 billion bushels at a marketing year average price around $3.45 per bushel. On the other hand, if you get a 92 million acre crop at 175 yields, then all of a sudden you're looking at stocks very close to this year's level at 2.4 billion bushels and a marketing year average cash price of $3.15. Now, what if we shift more acres, and right now the trend is going away from this, so it's not likely, but we end up with just 87 million acres and a 165 yield. Let me remind you, it hasn't been that long, 5 years, since we had a corn yield reflective of drought, yes, but just before we got to Kansas City, and the overall expectation that we won't shift quite as much. Anyway, as we look at it, 87 shift to soybeans. We have a bigger shift to soybeans here. I'm sorry, 87 million acres of corn, 165 bushels per acre yield. Keep in mind, it hasn't been that long ago, at 2012, that we were at 123.8 bushels per acre. So you put those factors together, you get ending stocks 854 below the psychological 1 billion bushel level. It gives you a marketing year price of $5.75 because to hold stocks at that level, I had to ration demand. Here again, the most likely scenario as I see it is we cut acres by 4.5 million and we get a trend yield and we're still up around 2 billion in stocks. That's not bullish, but it's not as bearish. And that's one of the things that the funds have been saying. Just like a year ago when crude oil, we were swimming in crude oil, so to speak. And we put a bottom in the market because the funds could foresee us during 2016 turning the corner to where demand finally became bigger than supply. And so instead of getting bigger month by month, stocks would start getting smaller month by month. Well, surprise, we haven't done that, but yet crude oil prices are trading at twice what they traded in the early part of 2016. And it's the same psychology that has done that in the past with grains and could do that again this year as well. What the funds are looking at is a trend. And even though these fundamentals are not bullish, they certainly are less bearish. And that can continue to be the case as long as South America doesn't have a big crop. Fund managers saying the worst is behind us. We really need to know the size of Safrinha corn crop to know if that's true. But if they have, if they don't have a huge crop down there, then in that case, that is possible. Soybeans, same type of scenario. 89.5 million acres of soybeans, up 6 million on the year, a trend yield of 47.5. Ending stocks fall to 355 million. Marketing year average cash price 10.10 per bushel. If, however, we get more acres and we boost it up to 91 million and we have a repeat of last year's yield, we have ending stocks with the 7 in front of it. Marketing year average cash price would project out to about 860 per bushel. On the other hand, if we do not get the big increase in acres, we only go up 3.5 million, we get a 45 bushel yield, which is what, down about 2.5 bushel from trend, down about 5% from trend levels. Ending stocks are at 168 million bushels, and that's with higher prices rationing demand. Probably would mean futures probing above $13 in that type of scenario. So a lot of potential, both bearish and bullish fundamentals here and price action here, and the funds love that. They love volatility. It allows them to make money. And that's a big reason they want to be owners of the soybean complex yet at this point. Not today, but overall, if you look at since the first of the year, they've been buying soybeans. They've been buying corn. The whole thinking is the worst is behind us. I don't think the markets have proven that. That's very possible. In fact, I could probably even say that's probable, but we don't know that for sure. So if you're unpriced on all the 2016 production, make sure you have some price protection. But that's why the funds are buying. Let's give some notice to wheat here and depth by spreadsheet. And just bottom line, I want to show that USDA did raise exports by 50 million. That brought it in line with where we're at now on exports. I'm still questioning this feed usage. USDA did come down to the 225 million where I've been at. I'm still questioning if we may be too high there based on what we're seeing in the country. Ending stocks, I'm a tad lower. As we look this next year, my bearish scenario has stocks at this level. My bullish scenario has stocks at a little over half of that level. Still not bullish, but certainly would justify the funds coming in and saying the worst is behind us. The most likely area is ending stocks at 870 million. Again, certainly not bullish, but it is less bearish, and that's what the funds pay attention to. But we're in an odd predicament or a bad predicament here. If prices rise on this very far and simply price this out of the market, we'll be taking those hard red exports back off the balance sheet once again if that happens. So, in summary, today's report does little to change the sentiment that the worst is behind us, but neither does it guarantee that. That's going to be predicated on what the size of South America's corn and soybean crops are. Protein continues to be the driver. That means hard red spring wheat and soybeans, and you throw in hard red winter as following hard red spring. But money flow rally thus far, the money flow rally thus far has simply been limited by a lack of bullish fundamental story. If we were to have a major weather story in South America, this market could explode, but we don't. A lot of people have tried to make the Argentine issue something, but frankly, the weather conditions have really improved there. And I just use as an example 2015 here in the United States, and we were inundated with rain in southern and eastern Midwest, and we ended up having a big crop. In fact, commodity weather groups looked back and found 3 other years of similar type of rain events to this year. 2 of those 3 had well above trend yields. The third was just barely below, and that was the driest of the 3 years. So with that, I'm going to open it up for questions and ask you to write out your question, and then as they come in, I'll be happy to answer them. So who will have the first question? Ready to take a question? Type them in the Q&A section of your screen, and we'll be happy to take a question as soon as you have it, whether it be about domestic. I might mention while we're waiting for questions to come in that USDA did boost ethanol demand for corn by 35 million bushels. That really wasn't a surprise to us. That brought their numbers more in line with us, although our data would suggest the USDA, unless the ethanol industry collapses here, should be able to push things a little bit higher yet in the coming months. Question from Francisco: is China going to start minimum prices for corn and soybeans again? Oh, that's been the debate. At this point, I don't think so. I think the free market reforms that they're doing serve them well, and at this point, they're finding other ways to support their agriculture. I know there's been a lot of stories of late about stocks dwindling there. They still have big supplies of corn they're trying to push into ethanol production and into feed usage and stuff like that. China's a little bit difficult to predict, so I'm going to hedge there. Pay more attention though to what they do rather than what they say. Okay, let's try the next question here. Thoughts about soy calendar spreads, high normal in November, July, November, but maybe overdone. David, I'm not going to comment on the soy calendar spreads. That gets very marginal the way we're structured under Dodd-Frank, and I better stay away from talking about the answering question. Apologies for that. Greg, how is California recovering from multiple-year drought? Well, it's going to take time. Now, the rains have come. They've certainly had a wet winter in many parts of California, and that has certainly helped improve the drought conditions. Comment here you have is affects almond and rice segments the most. Not really up on the almond and rice segments, but I do know that the weather pattern there has definitely improved. That's definitely welcome relief for a state that has just been, just had a really bad stretch of luck as far as rainfall for the last several years. Okay, Francisco again, any changes to Argentine policy of high taxes and exports on soybean? Generally, it's become a revenue problem for Argentina. They took the taxes off corn and wheat, as you know, but they only came down 5 percentage points for soybeans. But the talk is now that they may start a gradual reduction. I believe it's a 0.5% per month, slowly ratcheting it down in the months ahead and over time. So that's something we're watching for, trying to get confirmation. Okay, thoughts on other South America, Paraguay and Uruguay. As I've looked at their soybean crops, they look pretty good. I haven't been able to see a whole lot on their corn. Okay, next question comes from Russ. Are the wheat and corn markets tied together and trading together for feed usage or not? Overall, yes. Any particular day, no. And today, you're probably referring to today's price action. Well, wait a minute. let me get that right. Today, they did tend to trade together. There are other days when soybeans has a bigger influence on corn. But the bottom line is corn I would not call a leader. Now, if you look at the charts, it would certainly appear like more of a leader. Certainly doing a better job of trying to break out to the upside, certainly today as well. But over the longer haul, it is certainly more tied to soybeans. I do think we will see it be a leader more and more as we go forward, and the safrinha crop becomes more of a factor as soybean production becomes better known. Okay, thoughts on South America, Paraguay, Uruguay. I think I've given that as far as the soybean crop. Tom, will China continue to be a big buyer of milo, or has their purchase of Syngenta changed their opinion on GMO corn? Excellent question. Of course, all I can do is give my opinion based on observations. First of all, it's primarily Chinese end users, livestock producers, etc., buying U.S. grain sorghum, largely to blend with the lower quality corn coming out of the reserve. I anticipate we will continue to see small increments of that, although China officially seems to be doing as much as it can to discourage that, and has had some success with that, which is why USDA lowered its export target by 25 million bushels today, although pushing that into feed usage. I do believe that the Chinese officials have recognized that they need GMO corn, and I do believe that's why they are purchasing Syngenta, is to get the genetics. They have the big stocks of corn now. I think they see the day when that corn is either used up or rotted in storage, and they're going to have to boost yields. It was interesting to note out of their recent policy statement they release each year that they removed wording in there for the first time in 6 years about being self-sustaining in the production of commodities. That's highly significant. Cotton is leading. It competes for the area, right? You know, I don't normally think of cotton as leading the grains, but it certainly has had an impressive run in here. Of course, USDA raising its export target again today. We've seen quite a rundown in recent weeks of cotton exports just being very robust, and we don't have a lot of competition right now. I think the days are limited for this cotton rally. But for now, this continues to trend higher. A lot of people keep warning of a collapse, and it simply doesn't happen. This market seems to be well supported at this point. How do Ag 4 makers compare with planting intentions and final acreage? Do you have a graphic? Do not have a graphic with me to show. The one observation I have about the Ag Forum is it does seem to have a bearish bias, and it tends to be very uncreative in anticipating changing trends. The tendency is whatever's happening today, that's what we're going to project forward the next 10 years. So I'm not a big fan of paying a lot of attention to that. Any thoughts on the to-be USDA secretary? Don't really know a lot about him other than the fact that I keep reading positive things about him in the industry. Everybody seems to have a great deal of respect for the incoming secretary, Perdue. And so expectations that he'll do a good job and he's a good pick. What is the quality of corn from the standpoint of vomitoxins, etc., and how it would be affecting the supplies? Varies a great deal from region to region, a great deal. And some areas have quite a few problems. Overall, though, we've certainly seen a lot worse years. This year, while having some local problems, nationwide, I don't see the problems this year that we've had in some other years of late. When does palm nut production get harvested? Really here over the next couple of months, we should start seeing a significant uptick. Of course, the palm oil production last year was shortened by adverse weather in the region. This year it's expected to be a little bit better. Any shifts expected in the RFS requirements or use of it? Use of it in biodiesel and ethanol in the United States. Frankly, I think the biodiesel industry is going to struggle. I think the ethanol industry is shifting toward, okay, take away our subsidies and support, but get out of the way and let us market it. Give us access to the consumer. That's a little bit more of a challenge for the biodiesel industry, and I think it's probably going to have more struggles ahead. So that's all the questions we have now at this point. And so give it a little bit for one more question to perhaps come in. And if not, we will go ahead and close things out. And we will be back with you for the March crop report. Things start getting a little bit more excited. Appreciate those words of appreciation, Francisco, coming across this afternoon. Things start to get a little bit more interesting in March. We'll have a much better handle on the South American crops in March, and we'll be looking ahead to the acreage adjustments and see how close our survey results have been on the acreage. So with that, we'll close things off for today. I see one last question. What effect would the March interest rate hike have? The question disappeared. But I'll answer the effect of interest rate hike. Will they? You know, I think the Fed is getting worried because they're not seeing the tax and regulatory reform coming in the first 100 days. Thank you, Greg, for that comment. They're not seeing it in the first 100 days. So because they're not seeing progress, and keep in mind, this is day 20 of the first 100 days, so only a fifth of the way through it. But if they don't see it in the next 80 days, I don't think they raise rates in March. But if they do see it get pretty aggressive between now and June, we could have a 50 basis point hike as well. So at this point, I'm really not expecting. What does it do? It raises the dollar. It pushes the dollar upward, and that tends to be bearish, the commodities. They could still rally in that environment. They just have to have a stronger story to do so. So anyway, that wraps things up. Thank you for being with us, and we'll be back with you next month. Thank you.